Do you know the true extent of banks' influence on our global economy? We're committed to uncovering the realities that shape our financial world. We're diving deep into the enigmatic realm of banking and finance, unraveling the dark secret of how banks control the economy and their critical role in sparking the global financial crisis. Get ready to embark on a journey through the intricate maze of finance and power. Understanding the basics of banking. To understand the story, we must first understand banks. Banks are more than just savings and loans, they're the heart of the financial system. They manage deposits, provide loans, and control the flow of money, but their role extends far beyond these functions. Banks act as the lifeblood of the economy, influencing not just individual finances, but also national and global economic landscapes. By deciding who gets loans and at what rates, they shape business growth and consumer spending. Their investment strategies can sway markets, making them gatekeepers of economic activity. Moreover, banks are crucial in implementing government monetary policies, affecting everything from inflation to foreign exchange rates. This power, however, carries a significant responsibility. When mismanaged, it can lead to dire consequences, not just for the banks, but for the entire economic system, as evidenced in various financial crises throughout history. The power of banks in the economy. Banks have immense power in shaping economies. Through lending policies and interest rates, they influence economic growth, inflation, and even employment. This power, however, comes with great responsibility, and, as history shows, it's a double-edged sword. Banks are not just financial institutions. They are architects of economic destiny. Their lending policies can ignite or extinguish business ventures, deciding which innovations thrive and which ideas falter. Interest rates set by banks ripple through the economy, dictating the cost of borrowing for individuals and businesses alike. This can accelerate or slow down economic activity, impacting everything from inflation to job creation. However, this immense power is a balancing act. Missteps in judgment or policy can lead to economic downturns, affecting millions. Indeed, the history of banking is fraught with examples where this power has both built and broken economies. The prelude to the crisis. Let's rewind to the early 2000s. A booming housing market encouraged by banks' aggressive lending practices. Mortgages were handed out with minimal checks, leading to a bubble that was ready to burst. Travel back to the early 2000s, an era marked by unprecedented growth in the housing market. This boom, however, was built on shaky foundations. Banks, driven by the pursuit of higher profits, engaged in aggressive lending practices. They offered mortgages to a broader segment of the population, including many who traditionally wouldn't qualify. The allure of homeownership, spurred by easy credit and low initial interest rates, led to a surge in demand. But there was a catch. Many of these loans were subprime, carrying higher risks and adjustable rates that would eventually skyrocket. As homeownership rates soared, so did property prices, inflating a massive housing bubble. This bubble was not just a market anomaly, it was a ticking time bomb, with the bank's reckless lending practices at its core, setting the stage for one of the most significant financial crises in history. The crisis unfolds. 2008, the bubble bursts. The housing market collapses, triggering a domino effect. Banks, over-leveraged and underprepared, face insolvency. The crisis unveils the risky practices and the lack of regulation that allowed banks to gamble with the economy. In 2008, the inevitable happened. The overstretched housing bubble burst, sending shockwaves through the global economy. Home values plummeted, leaving millions underwater on their mortgages, owing more than their homes were worth. This collapse had a catastrophic domino effect. Banks, which had heavily invested in mortgage-backed securities, faced enormous losses. Many of these securities, once thought to be safe, were now worthless. The crisis exposed the banks' excessive leverage. They had borrowed heavily to invest in these risky assets, assuming the housing market would only rise. Additionally, the crisis laid bare the glaring lack of effective regulation and oversight in the banking sector. Risky practices like issuing subprime mortgages and investing in complex financial products without sufficient buffers were rampant. The financial system, once a pillar of stability, teetered on the brink of collapse, necessitating massive bailouts and interventions by governments worldwide. The global impact. The crisis wasn't contained, it went global. Banks' interconnectedness meant that the shockwaves hit economies worldwide. Stock markets plunged, unemployment soared, and governments were forced to bail out banks with taxpayers' money. The 2008 crisis quickly transcended national borders, illustrating the deep interconnectivity of the global financial system. International banks, having invested heavily in the U.S. housing market, found themselves facing similar crises. This set off a chain reaction, destabilizing financial institutions around the world. Stock markets, reflective of this global panic, plummeted, erasing trillions in wealth within days. The crisis dealt a severe blow to consumer and investor confidence, leading to a significant downturn in global economic activity. Unemployment rates surged as companies, grappling with the financial turmoil, downsized or shut down. Governments worldwide found themselves in a precarious position, forced to inject billions into their banking systems to avert a total collapse. This response, funded by taxpayer money, raised questions about moral hazard and the risks of banks being too big to fail. The crisis underscored a harsh reality. In an interconnected world, financial turmoil in one corner can lead to a global economic storm. The aftermath and regulation. In the aftermath, the world demanded change. New regulations like the Dodd-Frank Act in the U.S. were introduced to rein in banks' power and prevent future crises. But the question remains, have these measures been enough? In response to the devastating financial crisis, a global call for reform echoed across nations. The United States led the charge with the Dodd-Frank Act, a comprehensive set of financial regulations aimed at reducing systemic risk and increasing transparency in the financial industry. This act brought about significant changes: stricter oversight of banks, higher requirements for capital reserves, and the creation of agencies like the Consumer Financial Protection Bureau to safeguard consumer interests. Similar reforms were enacted worldwide, aiming to tighten regulatory control over financial institutions and curb their risk-taking behaviors. However, the effectiveness of these measures has been a subject of ongoing debate. Critics argue that while some aspects have made the financial system safer, others, like the complexity of new regulations, may have unintended consequences. The question lingers: have we done enough to prevent a repeat of such a crisis, or are there still vulnerabilities in our global financial system? The ongoing debate. The debate continues. Some argue that banks are still too powerful, while others believe strict regulations stifle economic growth. What's clear is that the balance between regulation and freedom is delicate and crucial for global economic stability. Today, we've explored the intricate and often shadowy relationship between banks and the economy. As we've seen, the consequences of mismanagement are far-reaching. We must remain vigilant and informed. Thanks for tuning in. Hit that subscribe button to stay updated with our latest content and join our growing community.